Hello. Welcome everyone to tonight's event. This is Nixon from CGS-CIMB, so I'll be your host for tonight. Just a quick check. Can you guys hear me well and see the slide well? If you can't, just type in the chat box. Thank you, Jason. Thank you. All right, thank you, Marcus. Thank you, Jess. So everything's looking fine. Great. Once again, welcome to tonight's session. I am looking forward to tonight's session because I think we're going to touch on something that is very close to all of us right now, which is the rising interest rate environment. And of course, we got none other than our expert and good friend Kong Hao to share with us. So without further ado, let me just do a quick intro. Okay, as some of you may know, and of course, welcome to those who are joining us for the first time. This is part of the Learn from the Pros educational series brought to you by CGS-CIMB for the year 2022. We have a market expert that we have sourced to bring to us their insight and expertise that we can benefit from. We have, of course, Kong Hao, which I will introduce later, and of course Seng Fu. Seng Fu just finished his Super Stocks workshop, so it was very well attended and a lot of people love it. So those who miss it, look out for the next run, which should be hopefully next year. Okay, a quick disclaimer. So basically what we are sharing tonight is basically for educational purposes only. It is not any investment advice or recommendation. So for any investment, do check with your licensed broker or financial advisor. All right. I'll next introduce Kong Hao. But before I do that, I just want to do a very quick poll just to gather some interest. I am looking at your preference for future events. It can be part of the Learn from the Pro series, or it can be any events organized by CGS-CIMB. We hope to have a bit of your opinion as to whether you prefer in-person events, that means attending live at the venue, or online events where you attend webinars or online meetings. So I just want to do a quick poll. So we appreciate if you can just click there. The second question is, do you prefer weekdays evening or weekends? And for weekends, do you prefer in the morning or in the afternoon? So just for us to understand a bit of a preference so that we can achieve organized events to meet more of your needs and requirements in the future. So I just allow a bit more time for everyone to make their poll. Thank you. I can see the response is coming in. Thank you very much. Hope to see more response. Okay, I should close the poll in another 5 seconds. So please click the response. All right, now I shall end this, and I'm going to share this result, so that all of us can also understand. So very interestingly, the first question is webinar or in-person? And I can see that 94% of you actually prefer online events or webinars. And of course, you guys are here online, so I guess there's also a preference for that because you are already attending online event. Do you prefer weekday or weekends? And I can see that close to 80% of you prefer weekdays evening. So thank you for your acknowledgement. So that we know that we are on the right timing, right track. So today is a weekday evening, and we will be learning more from Kong Hao. So let me close this now and go to Kong Hao. Yes, some of you might already know him very well. Tonight we are delighted to have again once with us Kong Hao, who was training professionally, and then he was also on the sell side with financial institution, and now he operates his own financial organization called Weipedia Private Limited, where he provides insights and educational programs to different financial institutions. So with that, I will just pass the stage now to Kong Hao. Kong Hao, please go ahead.
Yes, I think first of all, I want to thank you, Nixon, and for having me and for such a wonderful introduction. And I think the poll is really interesting that I think most of us prefer the webinar. So am I, that I don't have to travel. I can just at the comfort of my home and deliver across insight across borders. And of course, most importantly, I want to thank you all for signing up for today's program. I think I'm excited to share because in the preparation, there's also a lot of insight I gather. And I hope that the next 1 hour that we spend the time together, is also the Q&A, we will really rub on each other and learn a lot of things. So I'm excited to share. Let me just share the screen right now, my PowerPoint. Yeah. Okay, let me just do a switch over. Okay, so mainly the next 1.5 hours that we're going to share, and these are the, let me just narrow down something here. Now, there are 4 parts that I want to share with you, and I have to tell you that the inflation is here to stay. I think I just read the news from Straits Times that MES said that, yes, I just read that our Singapore Central Bank mentioned that the economy the growth will be slow, but that does not mean that next year the inflation will come down, although the growth is slow. So I'm gonna share with you the key number 1, which is very important, that what caused this inflation globally. So, and then I hope that'll be helpful for us to look at a certain set of numbers along the timeline next year and beyond next year, so that we will know that whether the inflation will continue to stay. So basically, in short, that if inflation is here, interest rate be higher, and if the interest rate is higher, it's always not a good news for stocks, companies, and even property investment. So that one we have to understand. But I think tonight I'm going to share with you a little bit good news, that there's something that the inflation globally, interest rate going to hike. There's something that as an individual we have no control over it. But how are we going to navigate and how we're going to take advantage of it? I think that's the key tonight. Not trying to paint you a very gloomy and dark picture, but rather to bring you from the darkness, and maybe we'll move into greater darkness ahead of along the timeline. But along the darkness, there's always some light at the end of it. I hope that throughout this one session, you'll find that light is so bright and that you'll feel excited with all this bad news that's going on, right? Then I'm going to share with you the part 2 will be part 2 of this this series, or this segment will be how long is this inflation is going to last. I'm going to share with you a numbers, what I call the 5.3%. And what is this 5.3%? If I'm going to share with you in a short while, okay? So if it dropped to 5.3%, I think there's all good news. There's a lot of hope that inflation may not continue to pick up. But why 5.3 very shortly? Then if the interest rate is going to continue to move up, and what are we supposed to do now? And then what else can we invest in? So I just checked with Nixon earlier before the session start that he said basically it's the investment, there's nothing much to buy because those that bought a little bit are stuck now. So everyone is like kind of freeze, and what can we do next, right? So there's a lot of other things that we can do. So I'm going to share with you. That's why I say I'm very excited. And I think I want to thank you, Nixon, for introducing about me. So what am I specialized in for those that hear me for the first time? I was a floor trader when I got started 27 years ago. And I learned a lot from the floor trading, because from the floor trading, that's the mass market participating there. People are shouting. And unknowingly then, as a young man, I learned about behavior science, or called market psychology. But today, as we study into the price behavior, actually we're studying into the market psychology. So today you're going to see a lot of that using the CPI, using the stock market. You're going to see a lot of that. So it's not just an entertainment. I hope you don't just take it as entertainment, but it's a learning. And this 1 hour learning, that I think my objective is that at the end of it, you can do it on your own as well. That's more important thing. And we're going to learn about how to identify the macro trend. That means today we're going to discuss about how to help you to manage your long-term investment, how to understand the macro trend in the future, and maybe not so much on the forensic price behavior, but you're going to see a little bit of that. Okay, so on my part of disclaimer is important. So what presented here, it is not a recommendation. So please consult your licensed broker. And my mission is to create lateral thinking skill for every investor and traders. knowing when to take a calculated risk with market uncertainty like today, and a bolder risk when opportunity arises. I personally felt that the opportunity is quite near for Asia. And yeah, you may heard me saying that at the beginning of the year, but my mandate have not changed. I'm even more excited because I received some texts, some email. Am I still investing in Asia? My answer is definitely a yes. I'm going to share with you why shortly. Okay, let's go to the first part. What really causes this inflation? And we got to understand about this is the US debt in total. At the moment, it's crossed about 31 trillion US dollars. I think it's not new to all of us, but let me just bring you to understand certain concept here. Now, it's not just United States. Of course, United States have the most debt, which is about 31 trillion US dollars, which is the public debt. Across the world, the European nations, different part, the Japanese, a lot of our country, they have debt. Over the years, they have printed money, especially after 2008. They saw that the US are doing that. Then the rest also have to follow, because if they do not follow, they'll lose out on an expansion of economy after 2008. So 2008 was a year where there's QE1, QE2, QE3 happened. That's where the central bank of United States printed a lot of money. And the rest of the world have to follow, because if they don't, then they'll lose out on their economy as well. I think even for my country, Singapore, they're quite tempted. Why? Because I was made to do a survey. Should we follow the rest of the OECD country to print money? And now, of course, I know Singapore did print money, but not to the extent, right? So it's always must have a certain balance. So let me just bring you to one principle to understand about the current global inflation. Now, you have to understand that every debt created, not just in the United States, but all over the world, it will dilute that currency. If your country, the central bank printed a lot of money, more than you earn, that currency will be diluted. When a currency diluted, it means that your currency, the currency $1 last year, it worth $1. But today, it's still $1, but you buy lesser thing. That's the problem with debt. When you print money, it dilutes your currency. And when the whole world print money in different currency, it dilutes their currencies. Now, then what's the ill effect when a currency is being diluted? Inflation happens. Okay, so now many of us will blame it on the COVID-19, will blame it on the Ukraine war. It caused the supply chain, both caused a supply chain. I can tell you that even the virus is gone, the war is over, say, for example, there's a peaceful resolution, the inflation will not come down, because I can tell you that the war and the COVID-19, the virus, is just a switch to a already existing problem waiting to happen, which it happened because of the COVID-19. Is a switch. Now, you just have to remember that COVID-19 and war, the Russian war and Ukraine war, is the switch to turn on whatever that's under current existing problem. It's just a switch to turn on. Now, let me just explain a little bit further, then we'll move on to something more exciting. So printing money is never wrong. It's just like individual, when we are young, let's say you got a good degree in a good industry, you're about to get married, you have a good career, right? So when you're young, there's economy in you. So you want to borrow money from the bank to buy a house, if you have got a good job, the bank will happily borrow money to you. So same thing for economy is from the 80s. I'm looking at the United States. When the economy is just at the beginning, at a growth, that you print money to, that's called the money supply. When you print money for expansion, these are called a good debt, just like our individual, right? But when you come to a point where you're too old, and that's the period of 2007 and 2008, that's where the subprime crisis happened, followed by Wall Street meltdown. Within that 2 years, to 2008, first it started with subprime, followed by Wall Street meltdown, and the last leg was Lehman crisis, the banking crisis. Now, then what happened here is that I think this term is not too new to you, from George Bush to Obama, because a lot of big companies come under the mercy of the Wall Street meltdown, and they're about to fail. So what happened here is that the central bank printed a lot of money from QE1, 2, and 3 to help all these companies sustain, because they need to create, they need the company, the big company, to stay alive so as to create job, which was a right thing to do then. But the ill effect is that, now notice what I say here, in 2007 and 2008, you notice the president said this, whether it's George Bush or Obama, they said this, that these companies are too big to fail. We have to save them. Now, that became a problem to me because it became that you print money just to sustain a lifestyle. In that context is that you print money to have the debt to sustain your economy. But having said that, over the last 12 years, the market, or 14 years by now, the market rallied through that, which is good, but the problem is still there. That became an issue. Now, you just have to understand that 2007-8, it became a crack to the whole thing, but it will take some time. In this case, it's 14 years for it to surface. In fact, 12 because it started in 2020. Money is printed to sustain the economy, and that's bad. Personally, it's like I'm borrowing money to sustain my lifestyle. And you know that if I take that mandate in my life or your life, you're asking for trouble. It's just a matter of time, right? So that's what happened to the US and many other countries. Now, how long is this going to last? Now, moving forward, you may want to do this. Yes, I know there's a lot of numbers that's coming up, and we got to look at US because US is important. It will affect the rest of the world. Is that I will be, of course, we'll look at other numbers as well, but especially for CPI, we have to narrow down on the CPI every month, okay? Because it will determine whether inflation will stay, and inflation is going to stay. It means that it will also determine that the interest rate is going to continue to climb. Now, so what we could see here is a demonstration of before 1980s. You could see that the interest rate, not the interest rate, the CPI. Now, what is the blue line and the red line? The blue line include the oil and food. Okay, the red line do not, right? So to me, oil and food is the most important commodities right now. How can you not include? So we just look at the blue line, and I'm going to black out this period here. So I just want you to see here is that before that, the CPI at one point was about 14%. Now, then, of course, the interest rate went up a lot. Okay, my apologies. Let me just switch this off. At one point, the interest rate went up to about 20%. Now, this is CPI, this is not interest rate. But after that, when the interest rate went up to 20%, the CPI dropped, which is very successful. Okay, when they hiked the interest rate to 20%, the inflation dropped tremendously. Now, I want to stay focused on here. It is from 1982 to 2020 April. The whole inflation has stayed in a very comfortable range. At average line is about 3% and below. Average, we gotta take about average, right? Now we could see that I would say that the Fed have did an amazing job having increased money supply, QE1, QE2, and different styles and ways of print money, that they have successfully contained inflation over the last 40 years. I want you to take some time to appreciate this because this is important. It'll lead us to why the inflation have picked up and it's not coming down. Okay, so which is important. Now I'm going to look at here. Now we got to understand that you could see that February and March 2021. So basically, the interest rate has stayed below 3% generally on the average. But April 2021, something happened. It went up above 3%. Now, you have to understand that the Fed have an objective. They know that printing money will cause inflation. That's why it's in their mandate that their target to then, before 2021 April, their target is that they hope to achieve every year increase the inflation increase by about 2 to 3%. And I would say that over the last 40 years, they did contain inflation successfully. But something have changed in April 2021 and especially June 2021. I'm going to share with you very shortly. Now, so what happened to this green zone is that for the first time, it break above this 3% comfort zone. Let me just see if I can bring you to the next one. Yes, okay. Now, it broke above the 3% comfort zone. That's what I mean by that. And I kind of zoom into the CPI over the last 10 years that you could see. Now, I'm going to go back here. Now, we could see that for the first time, it broke above 3% and it stayed above 3%. Okay. And that's November, December period 2021. If you still remember that the Fed make a statement, before that, December 2021, exactly the date is 14th of December 2021, Fed for the first time say that inflation, it is not transitory. But before 14 December, Jerome Powell mentioned that the inflation that's happening is just transitory. It means that because of the opening of economy, of the lockdown, they open up, people go up to the street and buy things, it causes inflation, but just for short term. Don't you worry. But 14 December, he made an alarming statement, which I'm kind of expected, but that changed the whole landscape. He said that inflation is not transitory. It means that in 2022, it's going to hike interest rate. They know, they also study into this number that, oh dear, it's like the inflation is not coming down, it's still above 3%. So this orange zone that we are seeing here is, it broke the 30 years high. Where's the 30-year high is this one? Okay, it broke and it stayed above. Now, the danger now here is that February 2022, it broke above the 40 years high. Where's the 40 years high is this? This was high point and it broke above. And it just not just broke above, it stayed above. So when Jerome Powell made that statement, 14 December, when I believe he studied the same set of numbers as I do, definitely, he see that, wow, the inflation don't seems to be coming down, which is risky. Again, I'm not trying to paint you a gloomy picture, but it's more about how can we navigate successful into a challenging future that we all will face the head with. Now, I'm just going to narrow down a little bit. Earlier, I mentioned about in the future, end of this year, next year, following year 2024, as inflation continue to pick up, come down, pick up, we got to find a point that when will the inflation slow down? To me, this point is very important. Let me just share with you, 5.3%. Why 5.3%? It's a bit technical, but it is so behavioral science as well. That we understand that over the last 40 years, just now we study about that, we could see that it kind of stay at an average of about 3%. But in June 2021, for the first time, it broke above this range, and that was the first peak, right? So in technical analysis, it's important that we understand where was the range, and the range was 40 years, that long. For the first time, broke above, and that was the first peak that it did its rightful retracement. In the uptrend is this. Usually an uptrend is very classic. You stay in the range for a long time. The first break, the first peak, it is important. Now you could see that the market come down with retracement. It fall new peak, retracement, fall new peak. Now, so in any time in history down the road, if inflation is going to come down to 6 or 7%, to me, it is not good enough to call for inflation finally taming down. It got to go below 5.3%. That you have to understand that 5.3%, it will send me a signal that finally the inflation is losing its momentum. Okay, it's just losing its momentum. The next thing that the Fed have to do is still have to bring down the inflation to below about around 3%, because that's their job. Because throughout the history, they know that 3% is right. They have to bring it down. So therefore, so later Q&A can ask me a question, why not this time they bring in the QE, lower down the interest rate to revive the economy? I will share with you why they can't do that this time around compared to 2008. Now, of course, we have a curriculum to share. I'm just going to move on. And let me just switch this off. Okay, now, then you got to ask yourself or myself, now, knowing that the inflation is going to stick for a time being, and knowing how to observe the data, what data to observe? CPI, US CPI is important. And so what should we do now? Now, before we talk about what should we do now or what can we invest in a appreciating inflation followed by a high interest rate, so most of the equity class will come down, right? But what is up? Yes, there's a lot of things that will be up later. I'm going to share with you what. So you just have to focus the assets correctly to invest into the long term. But before I mention that, I want you to understand about something about commodities now. So I have this partnership with one of the exchange in US. So every week I will post a strategy on this platform called TradingView. Yeah, every week. So you can go to my account, but I will also post on my YouTube channel as well. So if you don't have TradingView, it's okay. You can go to my YouTube channel. Later I'll give you my address. I'll post it there. Then after that, I also post it on my YouTube channel. You can follow that, all this trading and investment strategy there. So there's one topic I say about the CPI rally, which I just mentioned to you. What is that? Now, so one of the subscriber with TradingView mentioned that, let me just read to you very quickly here. He said, well done. I have been doing research myself for hedging inflation. And I think that people need to educate on this. I still learning much about myself. Assets value retention is key component in time like this. Yes, so he knows that inflation is going to be continuous. So he asked me a very good question. He said that, what are your thoughts on crypto REITs tips as hedge inflation against inflation? So my reply to him is this. I say, thank you. I'm glad you find this video useful. Now, I asked him, and I'm going to advocate that to you as well. I say, try asking ourselves this question. In a time of inflation, what else can we buy? I say, we got to ask ourselves this question. In time of inflation, what will be up? Or we will be paying more during inflation. Now, so think about it. It's just a very simple question. In a time of inflation, what are the things that we are buying now and in the future will be heading up? Okay, look at all these prices, the commodities. Those that's going to go up, it means that you buy those commodities or related companies, then I would say that you're in a good hands. Okay. Now we should be focusing on them, and we don't have to think too deep into it. No need to be so complex, right? It's something very simple. Inflation is going up, then what will be going up? The food, the commodities will be going up, right? Then I will be looking at them and those companies producing it, and I'll invest into them, or those funds or ETF. So let me just move on to my next slides. Now I want you to understand about this very interesting. So gold is one of the commodities, and I would say that gold is no longer just a commodities, but it is also a currency as well. Okay, now how will I time myself? So at the moment, I'm been accumulating commodities and Asia stock market as well. I'm accumulating them, but commodities, I'm buying them right now. And especially, I think I'll buy a bit, I will double down when I think the US dollar start to decline. Is it possible when the interest rate continue to move up, the US dollars decline? It is possible. Okay. We can discuss about that later on. But I just wanted to share with you this very interesting phenomena. Okay, so now gold is not just a commodities, but it is also a currency. I wanted to look at the opposite relation. You know, in the currency is always a pair. When I say dollar yen go up means yen come down, right? When I say dollar yen move down means that dollar weaken, yen go up. So same thing. I want to look at the history, especially after 1970. Now, this phenomena that gold is a currency against who? Against the US dollars. Now, look at this. And I also want to study about the characteristic of this gold, which is commodity. To me, it's an inflationary hedge. Now, let me just share with you why. Okay. Now, when the US dollars come down 66%, about the same period, the gold has appreciated 600 or six-folds. When the US dollars move up during this period to this period, about up 46%, the gold come down. So it's an inverse relationship. And when the US dollars came off, it kind of range trade, but from here to here, it came off 20%. Now I want you to notice that the gold went up about five-folds. Oh, sorry. Yeah, five-folds compared to this. So it's about 100% gain. Yeah. This down 20, you move up 100. Now, when the US dollars recently, when the Fed started to increase interest rate, naturally the US dollars be strengthened. So it went up 28%, and the gold at the moment is down 21%. I want to see the relationship that I mentioned about gold is a currency. So that's what I'm looking at now. I invested in a commodity, and I will double down a little bit more when the US dollars start to weaken. There you can see the relationship means that when US dollars weaken, the gold, I believe, would go up. And I also want you to see the characteristic between the US dollars and the gold. Now, what happened here is the US dollars and the gold is that when US dollars come down, the gold went up even more. The characteristic, you saw that? When US dollars move up, the gold came down the same magnitude. When US dollars come down, the gold went up even more, 5 times more, right? You could see that. And when US dollars move up and gold came down the same magnitude. So it kind of, I just try to, not trying to prove to you, but just try to let you understand the relationship that gold is not just a commodity anymore. is a precious assets that trade against the US dollar. So especially when the US dollars weaken, the gold will go up even more. And my focus is not just about gold tonight. My focus is about what can we buy today. To me, is commodities. Okay. Now, just another demonstration before we take the Q&A, that I'm going to look at this demonstration here is that I'm not going to compare the gold in 1970 to today, because I think if I'm going to do that, gold, that means have increased by maybe a few thousand times, right? Yeah, if I'm going to look at gold in 1971 or 72, gold was at 35 US dollars, and the recent high for gold is about 2000. So I'm not going to do that, because if you're going to do that, it's not fair for the rest of the asset class. So I'm just going to take about 2000, the year 2000. Why year 2000? Because in 1995, I entered the financial market as a floor trader. So my adulthood began from there. So I'm more familiar after 1996, that period. That's why I witnessed the gold have the trough at around 255 to the recent high. It was up about 539%, if not more, I believe. Yeah. Now, whereas compared to the US dollars, you say, well, US dollars appreciate a lot, but if I'm going to compare to the year 2000 and the recent high for the US dollars is still down 32%. But during the same period, gold has appreciated by about 5 times or 500%. That's what I'm seeing. I want to point out to you that gold is still a good inflation hedge assets. Now, a lot of market watcher, they when I read into their article or their delivery, they say that gold has no relationship on inflation. I think they're quite wrong, because what they're looking at gold is that they're looking from a day-to-day operation, week-to-week operation. But if you look at gold as a macro, like what I've just shared with you, you are able to appreciate better that gold, in fact, is a good inflation hedge instrument. Now, let me just share with you the next slide here. Yeah, that's what I mean here. I think you got to change this number, because this number should be 770%. Yeah. So this should be 717 from 2001 to here. Yeah, it's not 539. That's why I know something's wrong there. Now, if I'm going to compare to after millennium, we have basically after millennium, the whole asset class move up. For gold, we saw that. For the US market, stock market, you saw that. Why I like to use US stock market, because among all the securities and equities globally, US stock market is the best performing market compared to the whole world. So now, if I'm going to look at even after 2009, the Lehman crisis, from here to here, I think it's quite the same. Right? It formed a double bottom and it moved up. Now, the US stock market has increased by about 4-folds, and the gold has increased by 7-folds. I'm just going to bring a relationship to prove it to a point that gold is still a good inflation hedge assets, except that they do not pay dividends. And that became a problem. So, but of course, how to overcome the problem, then you got to invest in those mining stocks that pays dividends. Then, of course, how you going to identify those? Then you check with your broker. Yeah, so tonight I have this webinar with a broker. You call them. So the broker, you pay them commission. Make sure that you also give them some work to do, okay? Ask them, call your broker. I say that I want to buy some mining stocks, whichever country that have dividends. So let them do the job I recommend to you. So, yeah. Okay, so for the this commodity, so I started last series on my YouTube channel. I do it with the Trading View, a partnership with one of the exchange in the United States. But when I do that, I also post it on my YouTube channel. So what you could do is that the last series, I talk about commodities, and I talk about where are the commodities heading beyond 2022, whether fixed or floating rate. At one period, a lot of people write to me, say, should I choose for fixed rate for their mortgage or floating rate? So I produce based on that question, I produced this video. And I got to share with you that some months ago, about 2 months ago, I produced this video. I say that reason for crude oil to stay above 100 US dollars. And crude oil was at about $70. But I have the confidence that my outlook for my personal consumption, that I think oil will head towards 100 US dollars at the end of the year. Do check out this video. You'll know why. And then some of you say that, is it too late to buy the commodity ETF or fund? My answer is no. You can check out this video as well. So the latest video I've produced is that I talk about the inflation series. Yeah, this is called the inflation and interest rate series. So some part of what I've described tonight, I posted there, especially for this 5.3 and this in CPI rally. So if you enjoy what I just shared earlier, you want to study deeper, you can just go to the YouTube channel, subscribe, and just watch it through. Okay, just a very quick one. Now, so what else can we invest? Yeah, I'm mindful about the time because I want to allocate at least about 15%. No, what 15%? Okay, all my mind is about numbers and percentage, right? 15 minutes, not 15%, 15 minutes for Q&A. And usually with Nixon, with CIMB, the interaction with the audience is usually very tremendous. We have great interaction. So I want to allocate about 15 minutes for Q&A. Now, so what else can we buy? What else can we invest? And this is my portfolio or my mandate since the beginning of this year. If you've been following me, I think end of last year, I have a webinar with CIMB as well. Since end of last year, that was my mandate. And especially at the beginning of this year, when Jerome Powell mentioned that on 14th of December that the inflation is not transitory. So it gave me a clear signal that interest rate will be on the rise in 2022. So that's I crafted this mandate. US, I'm not exactly interested to buy and hold them at this point in time when the interest rate is continuously moving up. But I'm more interested to trade them. And especially be following my what do you mean by trade them? So during Q&A, I'll share, if you ask me the right question, I'll share with you some data from TradingView as well. So basically, the whole US market has started to turn downwards on the third week of this year. On the third week of this year, it started with because Jerome Powell mentioned that inflation not transitory, and you have to understand that inflation is a big element for the stock market. Why? Because I think many of us are living in a very great comfort since 2008. Especially if you're a young adult, you start investing in 2008 to today. That means the last 12, 14 years, you have never exposed yourself to what do you mean by high interest rate? Because all this while the interest rate has been low, and therefore the asset class, property, stock market has been going up. I'm going to share with you that therefore it's a big deal. If interest rate is moving up continuously, it is not a good news for the stock market or for the property market. And for the US market especially, it's been transiting from an uptrend to the third week of this year to a downtrend. So basically my US market, I don't mind to buy into them, but I'll keep it really short term. Say for example, in one of the forum, if you have been following, that that was Monday, last 2 weeks, I focused that the stock market has reached a low. It's time to buy, but be mindful that the whole trend is down. So when you buy, keep it short term, maybe hold for 2 weeks to a few weeks. That's about it. Then you got to cash out. So US market to me is fantastic to trade at this point in time because it is very volatile. So US market, I would like to trade them and accumulate all this small profit, because when you accumulate all this small profit, small become much. So of course, if you want to trade the US market, you have to be mindful that don't buy something you want to go for short term, then get yourself stuck and hold for long term. So you have to understand that if you're going to trade the US market, make sure you follow mandate. Trade them means that you buy. If wrong, then exit. Take a small losses and forget about it, then you move on. Now for Asia market, maybe especially I think the focus now is the China market. After their CCP meeting or CPC meeting, whatever you call that, the market have come down. All of us understand, right? But like what I said, the mandate for the Asian market since the beginning of the year until today have never changed. Accumulation means that I like them, the Asian market. I will gradually buy them. Say that I have 100 Sing dollars or ringgit or US dollars to buy into Asia market. Each point, I will like each proposition to buy, I will buy maybe $10. So that's called accumulation, right? Now, when US market down, Asia market will also come down. But I felt that the Asia market, the more it come down, the more I would love to accumulate. It's called the dollar averaging strategy. Now, dollar averaging strategy, you don't buy it at the beginning of the downturn. The Asia market has already been moving down for quite a long time, so it's time to deploy dollar averaging for the Asia market. That's what I'm seeing, because maybe you don't subscribe to the idea, or you subscribe to the idea, but that doesn't matter. But I'm seeing a transition of economy or power from the West to the East. And I'm seeing that. Okay, so later on during Q&A, you can discuss more. And commodities to me is just to buy them. And of course, it's a short webinar. So I hope I can spend more time to discuss all the three markets. So therefore, just now I share with you the YouTube video. You can go and visit them. The more you study to them, watch them, I think the more you pick up the ideas why commodities to buy. Now, when I say I buy in commodities, doesn't mean that you buy right now, the next moment. Buy means that you position yourself, the next retracement, look out for them. Either buy into ETF, funds, commodity, or these commodities related stocks. Of course, if you want to buy straight into the commodities, you can do that, but those are more towards the short-term trading. You can buy into the CFD or futures. I believe that CIMB, they carry all of this as well. Okay, so these are the three markets that I'm into, and I just want to share with you why Asia. Okay, is something a phenomenon that I see since 1995. I entered the industry, means about 27 or 28 years by now. Now, you know, Singapore market is always a very small market. We're in the mercy of the big brothers. I think Singapore investor, you have agreed with me, in the past, when US market down 10%, say for example, we'll move down by 15 or 20%. And when US market up by 10%, we'll move up 5%. We're always not performing. And when US catch a cold, we'll catch a COVID, something like that, right? But starting this year, I see some interesting phenomena that end of last year to this year, in the first quarter, the NASDAQ have moved down tremendously, that you could see here. But I could see that the STI have moved up in the opposite direction. That's a phenomenon that I've not come across over my career over the last 27 years. So in this relationship, and it's not just during this period, even today, okay? Let me just share with you the next slide here. This is the latest where Singapore market also came down 14% from our all-time high, recent all-time high. And this is NASDAQ all-time high to its recent all-time low. It is down 37%. But Singapore market is only down 14%. So I want to see that where is the smart money going to, where they are kind of liquidating the US market, taking opportunity. But the money is still there. When they liquidate the smart money, they have cash. They have to find somewhere, right? So I felt that the money is coming into Asia, and Singapore, I kind of like it. Yes, I know it's a bit slow, but during this period, I think the strategy is really to find a safe haven. So I think the investor, not just in Singapore, but overseas, find Singapore stock market as a safe haven. And one of the good dividend payout companies are here listed in Singapore. It's not because I'm from Singapore I talk about Singapore, because as an investor, we have to invest without a lens. Yeah. So over the before 2020, before that, I worked with SGX a lot. I mean, I still work with them, partnering with them. I never advocate that Singapore is buy and hold. Yeah. But now I will advocate that Singapore, if you have ability to hold for at least 5 years or more, buy and hold into Singapore stocks, buy and hold into Asia stocks. I think 5 years from now, 3 years from now, you'll see the effect, the attributes of buying to Asia stocks. Now, with that, I think I want to spend a little bit more time on Q&A. And I have this tradition with CIMB, or maybe with Nixon, that usually the webinar will exceed the stipulated time at 8:30. He will ask me quite a bit of many questions there. So if you want to follow me on my in my Facebook page, it's called Kon Hao, my name joined together. Every day I spend about 1 or 2 hours reading news widely, and especially during this period, I have to read one news. I have to read from 3 sources because I need to strike a balance. I need to read from the West, from the East, and from the Middle East. After that, I need to strike a balance. Who is saying the right thing and who is saying it's a propaganda? So I have to make a sense of balance. So then after that, I give you my insight, and I just put in point form. So my Facebook page, Kon Hao, 2 names joined together. Every day I'll post insight of the market. And my YouTube, that's where I will share investment and trading strategy on a weekly basis, because I partnership with one of the exchange. And you can find my YouTube channel in this name called Invest and Trade with Insight. Okay, so you can subscribe to it. And then any question, if I fail to answer and you find that what I've discussed today, it give you a lot of insight, you have a lot of burning questions, feel free to email to me, conhao@weipedia.com. But please don't ask me what stock to buy. If you ask me this question, I'll refer you to your stockbroker. Okay, ask me something about what we discussed tonight. You have developed certain insight, okay, and you do not quite understand. I would be happy to explain to you. So maybe I'll pass this time back to Nixon and for the time of Q&A.
Right. Thank you very much, Kong Hao, for your very insightful sharing. We have quite a few questions in the Q&A box. But before we proceed with that, allow me to just share my screen here. All right. So we would like to get your feedback on the session for the webinar. So if you can, maybe you can scan the QR code, or let me also just put the URL on the chat box. All right, so we'll appreciate your feedback. All this actually goes towards supporting the webinar, because the feedback actually goes back to management, where we can then tell them how the audience feel, and if we do a good job, we can get funding to do more of this webinar in the coming future. So really do appreciate your feedback. So with that, I'll move to Kong Hao. We can start the Q&A session. Kong Hao, you can see the Q&A box, right? So
yeah, maybe you select the questions you find that is appropriate. Then I may not able to answer all the questions, but I'll try my best, whatever I know.
Okay, we'll do our best. Maybe we just start from the beginning then. There's a question asking about what about inflations in other countries?
Yeah, okay. So why I focus on US market? Because US market is the largest GDP. It is also the US dollars tied to US dollars. It is also reserve currency. Reserve currency means that, let's say, between Singapore and Malaysia, say for example, if we with the businesses we buy from Malaysia, so some of the product we have to deal in US dollars. That's how important US dollars is. Although it's nothing to do with US, but we have to deal in US dollars to that relationship. So therefore, it's important that we first have to keep track of the US CPI. And because when the inflation pick up, naturally the rest of the world pick up. When not just inflation pick up, but when the Fed increase the interest rate, the rest of the central bank will also have to follow, because it's the largest market. Because if the rest of the central bank do not hike interest rates, so what happened here is that now the interest rate, say, is about 3% USA, for example, and if your country maintain at about 1.5%, so what happened here is that your countrymen will sell your country currency to buy into US dollars in your own country and put in a fixed US dollars, and that became a problem, right? So when the Fed increased interest rate, the rest of the central bank were likely to follow. They have to do it, because if not, they're going to lose out on their currency. Yeah, so of course, they cannot move up too much, so they have to measure it from time to time. So if you're in Singapore, how our MAS or the Monetary Authority of Singapore, they do it is that they try not to touch the interest rate, but they try to intervene our Sing dollar. They try to make the Sing dollar as strong as possible to counter inflation. So different central bank will have different way of dealing in things. And I just have to say that I think being here in Singapore, I think we're quite blessed. At least the central bank have the ability to intervene our currency against the US dollars or against the basket. So they try to avoid hike the interest rate, but they have done it anyway, but not in that competitive spirit with the Fed. That's what I'm saying. Yes. Okay, great, thanks. I think basically another way to understand this is basically looking at US as a macro indicator, right? So because US actually lead a lot of the markets in the business right now is still the biggest
so-called capital market in the world. So whatever happens there affects the rest of the countries.
Yeah, definitely.
Since we are on the topic of inflation, let me just look at questions related to that. Okay, there's one from Leo Tan. He's asking, if inflation were to fall below 5.3% or even more, does commodity investing still make sense?
Yeah, so I think the wait for that to happen, but I think unlikely that the CPI will come to 5.3%. But of course, what I presented to here is based on my personal assessment for my own consumption, right? So based on what's happening and based on what's happening historically in the past, that earlier, if you stay through the whole program, I still discussed the first part is that the printing of money was the yield effect over the last 40 years, or at least the last 14 years after the Lehman crisis. The yield effect is that the inflation will pick up. They just need a trigger, which is the COVID and the war is a trigger, right? So I think that unlikely the, based on my assessment, difficult for the CPI to come down below 5.3 and stay below 3. Yeah, 5.3 is not good enough. You have to stay at about 3% band. Looking at the situation, I think unlikely to happen, but just in case I am wrong, yeah, because as an investor, we also, now as an investor, there's no such thing as absolute. Means that whatever element that we consider, in fact, alignment, 100% we will make money. There's no such thing, right? But in good faith and good confidence, that's what I presented to you. I think if some of you have been following me since the beginning of the year, I think my mandate have never changed until today, right? So the China market has collapsed in a way, but my mandate is still the same. I'm even happier because I can accumulate more of the China stocks. Yeah, that's my mandate. So now, no matter how confident I am, there's no absolute to it. But I still leave chance that the gentleman to say that what if I'm wrong, that inflation comes down to 5.3, it may happen. Then at least the commodity I bought, I will do a slow exit. Because why? Because the commodity I have, I did not buy at the high. I buy around the retracement. Yeah, so I didn't buy the high. So it's not a collapse. So if inflation comes out below 5.3, commodity may ease off a little bit. I will do my slow exit. I'll make some losses, but not a heavy losses. So it's a very good question. So thank you so much for the question. Right,
thank you. So let me go to the next one that is related to that topic. Okay, this one from Anonymous, it says, with risk-free interest rate from T-bills and bonds going up, won't dividends-paying stocks go down as investors demand higher yield from stocks?
I think the bill down, by the way, is not going up. So I'm not too sure your question, what is it driving at? Yeah, because the bills and the bonds, the yields are all coming down. Yeah.
Yeah.
Yeah. If you're looking at the weekly and monthly chart, starting from this year, in fact, starting from this year, all the bonds, maybe I'll show you a chart. I think that will make more sense, right? Yeah, let me show you a chart. Let me just share my screen on the trading view. I hope that I get this correctly. Okay. So Nixon, if you're not seeing my screen, do let me know.
Yeah, I can see your trading view.
Okay. So this is the okay, just wait for it to load a little bit here. Okay. Now, so these are T-bonds. And T-bonds, this is the yield. Yield is interest rate. So on the top is 2 years yield, 5 years yield, 10 years yield, 30 years yield. All are going up. And let's look at the bonds. And the bond price is opposite of the interest rate or the yields. Okay, let me just share with you this. Now we could see that I'm starting from what a quarterly chart. Quarterly chart means that I can study all the way to 1999. The bonds has been coming down. It's not been going up. And you could see that plot a very nice trend line. And this is futures. If you look at bond cash, you can even start it further to the 80s. And even if you study to the 80s, you could see a very nice uptrend line. Maybe I just clean up a little bit here. Yeah. And we could see that if you can get hold of the cash chart, that'd be wonderful. Can you see that there was a perfect uptrend line about here? That's the bonds market, right? Now, bond market is the biggest market in the world. If you're going to combine all the stock market, it's not as maybe is the same size as the bonds market. Okay, now we could see that in 2022 April, you could see that you start to break down below this downtrend line. Now I know it's technical analysis. Some of you may not apply it. But I view technical analysis beyond technical analysis, because when you study into the price chart, when you look at the chart, we're studying into what? We're studying into the price behavior, right? So to me, the bonds is moving down. So is the gilts. Gilt is the UK bonds. So we could see that the bonds has coming down from here to here. If I can recall correctly, is down about 37 or 38%. And if you talk about the UK bond, is very bad, right? From the recent all-time high to the recent all-time low, where Liz Truss did a shift in policy, the UK bonds collapsed. It was down 35%, but in fact, US bonds down even more. Okay, so I'm not exactly sure where you're coming from. Maybe we'll take on the next question, but I just want to share with you the bonds market are in a way collapsing. So yeah, then we can see that the yield, 30 years yield, which is the interest rate. This is something really interesting here that we could see all the way to 1980, that the interest rate for the first time, it just broke above the uptrend. So therefore, let me just clean up a little bit. Therefore, let me just have this for a little while, then I'll pass it back to you. I'm trying to draw something here. Let me see if I can find that. Okay, this one. So therefore, I'm suspecting that the interest rate may be doing something like this in the future. By the way, this is about 30 years. 30 years interest rate, 10-year, 30 years. Yeah, you only just have 30 years interest rate. For us, Singapore is 2 years, 5 years, the bond, the mortgage that we have. So that's why you could see here at the moment, the interest rate have broken above the downtrend line. And I think since last year in May, I start advocating that interest rates maybe going higher, just take note of it. So now it's already happening and it's transiting from a low point to a high point right now. So yeah, so I'm going to pass this time back to you.
Yeah, okay. I think the basically it goes back to the standard knowledge that the stock market is inversely correlated to the bond market in terms of interest rate. So interest rate goes up, stock market tend to go down.
So I know it's very confusing between yield and bonds. Just have to understand yield is interest rate and bonds are bonds. Yeah, so bonds and yields go opposite direction. So is bonds and interest rate. So therefore, I have all this Facebook insight. Do read, because every day as you read more and more, I think you'll get a more understanding about the market.
Right. Okay. There is a question regarding bonds. Since we are talking about bonds, let me find that question. Okay, from Anita actually. Her question is, the bond this year is doing quite badly. So basically it's bond price, I guess. Interest rate go up, so bond prices come down. But for those already who have bonds in their portfolio, what can they do?
Really depends on what kind of bonds you have, because I really can't advise you. Basically, I think when we start into US bonds, you give you a very clear insight where the bonds will be heading. What can you do? If I will have bonds, but I do not know what kind of bonds you have, it could be a company bonds, right? So then you have to look at your company, that company bonds that you're investing in. But if you talk about the US bonds, if you have the US bonds, I will, if you are in that situation, I will ease off a little bit or half of it, create a liquidity for me to flow into something else. Yeah, so liquidity is important, because I think one of the most painful thing about investment is that when our money are stuck. Okay, I do not think all of us do not want that, right? Because once your money is stuck, even you see a lot of opportunity after this webinar, you have some insight, you want to do something, want to buy into a little commodity funds, your hands are tight because your money are stuck. So it's a very painful thing. So what I could do is that, if I also know that it's very difficult to part whatever you've invested. But what you can do is that at least you clear part of it, then you flow this amount of money to somewhere else. Yeah, a greener pasture. So that's something that it became a hedge. Yeah, so you can consider that. Yeah. But of course, you talk about bonds. I think very interesting if you can access to certain data here. Of course, I study into the US bonds, also studying into the China bonds, right? You'll be surprised that go and study about the China bonds and where is the China bonds heading and where is the smart and hot money flowing into. Okay, so we may read into one media saying this and that, but I want to see the real action that's going on. What I'm seeing here is that China bonds are in the uptrend. Is not like that. China bonds, this is a yield, by the way. Okay, let me just switch back to, I'm not too sure if you're still seeing the my trading view. So this is the 30 years bonds, and China bond is very different creature completely. Yeah, so it's still hanging along the uptrend. So that's where I try to be, don't have a lens on, as an investor, we have to remove that lens whether you like or not, because it's my money that we have to place it correctly. So therefore, I study into the actual market, where is the hot money going into. So what is telling me that the China bonds are on the uptrend and is pending up, whereas the bonds, the T bonds that I'm seeing, is the market is telling me they're still on the way down. Okay, so much about the bonds.
Great.
Yep.
I'd like to pick the question from Walter Wong. His question is, if inflation is to stay high longer, let's say for the next 6 months, it doesn't come down, despite all the interest rate hike, do you think the Fed will stop hiking and decided to just live with the high inflation?
No, I think the Jerome Powell style is that he wanted to adopt the Volcker style in the 80s. So what happened to Volcker style in the 80s is that no one have this concept. And that's where in the 80s, who is the president then was Jimmy Carter, and he only served one term. But he got in Volcker to come in as the central bank federal chairman, got one mission. Okay, Jimmy Carter got one mission. I think he's a great man. But that also killed his own presidency the next term, because he, I think it's a collaboration. Volcker and him is that they have one mission, is that especially the central bank chairman then, was that his mission is that he wanted to try something. Okay, he's very determined to try something, which is to hike the rate more than the CPI, which he did. Okay, just now earlier the demonstration saw that the interest rate went up to 20%, whereas the CPI was at about 14%. So he did that. But that also cost Jimmy Carter his presidency the next term. So he lost that. Okay? But I think it's a very necessary move. So now, Jerome Powell, I think his mandate is he did give some clue that he may attempt that, come to a point that he want to up the interest rate higher than the CPI. Yeah, so that may happen. At this point, they can't do that anymore. That means they cannot sit back and don't hike the interest rate, because CPI matters. Now you have to understand that in 2008 and today is very different, because 2008 they can reduce the interest rate and print money, was because that CPI is still at about below 5%. It was very much under control. You understand why today they have to hike interest rate and cannot QE or print money. The reason is because if it's going to lower the interest rate and continue to print money, it's just going to make the CPI even worse, because now the CPI is already at 8.8, 8.29%, which is, they cannot afford to go back to 2008 strategy. They can't do that anymore. Yeah.
Right. So that means we do not have any
I think the Fed have no room to maneuver.
Okay.
The only way is, that's why I say that focus the numbers that we have to take a look every month is the CPI is important. And they have no other option other than to hike the rates. That's why I have.
Yeah, I think the gist of the question is, do you see that there's actually a cap to how much they can hike, or we are looking at something?
That's why I say there's no options. They will have to hike if CPI continue to move up.
All right, so we are not looking at any limits right now.
No, because this time around, compared to 2008, is that 2008 they can ease the interest rate because they have to save the company, because they can save jobs. When company stays, they can save jobs, right? But today the story is very different, because it hurts the 90% of the population. When inflation move up, the larger population is 90% are hurting their pockets right now. So therefore, the government of United States and the central bank, their job is to help the larger population. Yeah. So in the past, in the 808, they are single-mindedly focused on corporation because they know that as long as the big corporations are safe, jobs will be protected. Yeah. But today, the whole story is very different. The focus, because 90% of the larger population are facing with high inflation, high cost of living, they have to work on them right now. So it's a very different story now.
Right. Which is also kind of scary because if you don't see the limits.
It's a very difficult situation for the United States today. Yeah.
All right. Okay. I think next we should move on to China, Hong Kong, because there's a couple of questions on that topic. So maybe I'll just pick one here first. So it says, hi, Kong Hao, do you think that China is still suitable for long-term accumulation investing, given the increased political and geopolitical risks? How do we go about managing our risk in our China position?
Yeah, very good question. Okay, I think some of you may know that I have this concept. I think the first time I have, since after I got Nixon joined CIMB, the first time he invited me, I think that was end of last year. So I share on this concept. If you are still in the TradingView platform, I hope you can see the chart now. I just presented you the NASDAQ, right? Okay. You could see that over the span, because of this, I coined this matrix. I think it's going to be very helpful for all of you. That every cycle, the 4-stage income value growth and decline. So we could see that the US market perhaps are just at the beginning of the decline stage with all the elements that I just showcased to you, right? So where's the hot money now is that I think it's moving into the yield market, is moving to the commodity market, and maybe a safer bet if you want to buy and hold, dollar averaging accumulation, right? Earlier I talked about the Asia stock is accumulation, means that not buying now, but slowly accumulate is the market. Okay, I'm going to share with you this slide. Let me just go back to my PPT. Nixon, can you allow me to go back to PPT?
Can. You can just share. You have control.
Okay, let me just share my PPT right now. Okay, so let me just share this PPT with you. And where's China and Singapore today? A quick one. China, I felt is here right now. If you base on this matrix that I have coined, okay, let me just. So China today is about below 12,000, right? If you use this matrix to map it, income value, I want to look at the years, right? So in fact, the last 2 years where what China trying to do is, in 2001, they have all this clamping down of the property, entertainment, education, right? So what they're trying to do here is that if they don't do it last year, I think this year even worse, right? So what I'm trying to share with you here is that, let me just share with you this. Yeah, so 2021 was a year of crackdown for China. But can I share with you this is that if they don't do in 2021, it seems like they know what is coming ahead in the global interest rate or global inflation. I think they can sense it because since May 2021, as an individual working from home, if I can having messages last year in May 2021 that interest rate is going up, I think the think tank of China will also know that in 2022 interest rate is going up, right? So now if they don't crack down a property boom last year, if they do it today, I think they'll be in a worse off situation. So what the Chinese trying to do is that they're trying to achieve a soft landing. Okay. Now I'm going to share with you this soft landing here. So now you can see that 2021 and 22, I think they have achieved a soft landing. They know that moving forward is still a very challenging time for a global market, but they do not want their market to collapse so quick, so sudden. So in my context, I think that they have achieved a soft landing, and I feel even at ease to invest in better companies today in the China market, in those Chinese stocks listed in the Hong Kong market. Do check with your broker, of course. What I'm sharing with you some strategy, some mapping technique, but when you select individual stock, you still have to go into the macro, the micro, look into it. That's where the broker will be helpful. So for the Singapore market, that's what I'm saying. If you're going to map it between income value, and I think where's the value proposition for Singapore market is that we are already a financial hub, tech hub in Asia, definitely, air hub, Trading Hub. White Trading Hub, if you've been watching the National Day rally this year, that PM say that they're going to build a port that is double the size of the current capacity right now. Means that they are ready to take on the world, And today I just read about we're going to be a hydrogen power hub as well. Okay, so there's a lot of value to look at for Singapore market in the near future. Of course, the stock market is still not too vibrant, but as all these real business come in, they will seek listing in Singapore market. So I don't mind to get in the Singapore market right now. That's why I say that the Asia, I'm accumulating it. Why? Because I think the downside risk is a bit lesser. That's what I'm saying here. I'm talking about in the perspective of the next 3 to 5 years or more. Yeah. Okay, so thanks, Nixon. I just want to sum it up, give you a lengthy answer because I think they may have a lot of similar related questions.
Correct. I'm looking through the question. I think the whole idea is about investing in China, Hong Kong, because given Singapore. That Singapore as well. Given that in China, because of the policies from the government, as well as certain crackdown and the impact the US restriction as well. Do you see? I know that your idea is to accumulate. So, but then it seems that things are still moving down. So in terms of timing or in terms of the sector, what are we to be aware?
Okay, I think first of all, I think the dollar averaging strategy is for accumulation. So if you ask me to do dollar averaging in the US market, I'm not exactly keen at this point in time. But dollar averaging strategy for the Asian market, definitely I'm keen. So each time when it hit new low, means that I can buy at a lower price and accumulate more units. And that's basically about the whole dollar averaging strategy. Why the word accumulation? Accumulation means that I have no exactly idea when it's going to turn up. And that's powerful strategy about accumulation. And particularly what sector, I do not know because of course, right now at this point in time, you ask me about what sector is always about technology. It's about bioscience and maybe some of it into engineering. Yeah, especially times are into engineering for warplanes because as the market is, to be very clear, who is making all these technology for high-tech vehicles, all this and that. Of course, you got to check with your broker, who are they? So all these are, you just got to ask yourself, the next trend, whether it's in US or Asian market, what is the trend setter of the market? Basically very simple. It's still technology, it's still e-commerce, it's still bioscience. So these are the industry that will bring forth trend. Trend means that you move up, right? But if you're going to invest in property and banking stocks like what Singapore we have, the STI, generally if you're going to invest in that, it's just a range-bound market. If you could see, if you're still on an STI chart, that you can see over the last 10 years a range-bound market. Why? Because most of the students in the STI are banking and property stocks. So therefore, there's a reason why STI has been range-bound. So range-bound is another trading techniques or investment techniques. But if you want to invest something that can bring forth the next trend, it got to be technology, e-commerce, and bioscience. So that's the industry that we should be looking at.
Okay. So am I right to say that between the Singapore market and the Hong Kong, China market, the preference will be for Hong Kong, China? Or?
Yes, I think at this point in time, because the listing in Singapore market, we don't have a lot of e-commerce and high-tech stocks, right? Unfortunately, most of their high-tech stock are not listed here in Singapore at this point in time. Even the company that choose to have their operation in Singapore, they have not listing, but that does not mean that in the future they will not list in Singapore. Yeah, so I think to me, Singapore at this point in time, one of the better investment contracts will be STI, yeah, because STI along the way it will have reshuffling, yeah. So I will not know in the future who will be added, who will be out, but if you can accumulate STI, so to me it's one of the assets that I have is STI ETF. I think it's not too bad. You can consider that. So yes, you're right, Nixon. I think you dig out some answer from me is that I think most of the good value tech stocks is still in Hong Kong, the China stock listed in Hong Kong. You can take a look at them. Yeah, only they do not pay interest rate or dividend. So it's always good to have a basket of stocks that you can spread out and even out. Yeah.
Okay, talking about China, there's an interesting question from Jeannie Tan. The question is, do you think the renminbi will be used as an alternative currency besides USD for transaction in coming years? And if yes, what will be the impact on China's share market?
Yeah, that one I cannot answer because I think that's what Chinese government wanted, right? But whether will be successful, nobody knows. And I think then you know why am I saying that, because when buying to the Chinese related stocks, when you buy into China stock, actually you're buying to renminbi as well, right? So yeah. So but I think buying to the China related stock, you also buy in renminbi. There's attributes because I think first of all, you may receive dividends. And secondly, it's not just a currency appreciation because you may receive capital gain. And but thirdly, if renminbi appreciate, your stock will also appreciate. So I think I still prefer to buy into the China related stocks in Hong Kong or China itself. By the way, you can buy into the China stock direct if you want to today. Yeah, so that's how it works. I prefer to buy their stocks than their renminbi. Yeah.
Okay, great. There's one question from Anonymous. What do you think of the Vietnam stock market? I think I will just pose a general question. I mean, besides Singapore market, Hong Kong, China, in Asia, developing market like Vietnam, even Indonesia, Thailand, what is your view on those markets?
I think Indonesia and Malaysia have a good hope. So is Vietnam as well. So you can see that the ASEAN country are actually banding together in a time of very uncertainty. I think the recent Vice President of the United States that visited, was it this year, beginning of this year? Yeah. I think the ASEAN band together say that we don't want to choose side. I think the reason why they want to choose side, they tell the Vice President of the United States that before she came down, we don't want to choose side because we know what's her agenda, right? So basically why we don't want to choose side because we still want to do business with US, we still want to do business with China. So I think the whole ASEAN country are very single-minded that we are business people, we're businessmen because we want to bring the business for our countrymen. I think that's very important. So I can't speak specifically whether Vietnam, Indonesia, or Malaysia. Yeah, maybe there's a topic about ASEAN next time. Then we'll study deeper into it. Yeah.
I think there's an interesting question on that point as well. Besides ASEAN, what about like the other developed countries like Japan? Japan, Korea. What's your view? Or do you have any view on that?
Yeah, I think I maybe I'm not gonna take that question because if that question I got to study specifically into it. Yeah, because I think the Japanese problem a bit concerned is that they are also into this debt issue. If not, in fact, their debt to the GDP is higher than United States. So that part I'm quite concerned though. Yeah, so I think we have to study into the individual country and perhaps the industry. So I cannot really answer that Japanese question. Yeah, but I'm concerned about their financial health as a whole. Yeah.
All right. I think another point is it's not a popular market, I think, for Singaporeans as well. I think one of the things is basically because of market access and maybe also language issue. Because I think for the Japanese equity market, a lot of things are still in Japanese.
Yeah, so the other, maybe you have interested, you kind of stimulate your mind today after the webinar is that do consider about Asia Fund if you have. So let's say if you're keen to, personally, I like to invest in Malaysia, Indonesia, this country that I'm more familiar with, and of course, China, Hong Kong, and Singapore market. But if you find that what I spoke about over the long term makes sense, where US market should decline, and of course, when US market decline, we will also kind of suffer, but not as much because we always focus on the potential downside risk, which I find that the Asian market will not be as great. What you can do is that if you find whatever you discuss make quite a bit of sense, that you're quite prepared to load into the Asian market, you can consider all this Asia Fund. let the fund manager do the job and get hold of the prospectus and study into what the fund manager actually invest into. If you like to invest into countries and different countries like what you just mentioned, right? Then let the fund manager do the job. I think that will save you a lot of trouble. Yeah.
Right. So basically, we can still go through like more developed exchanges like SGX or Hong Kong Exchange and get into the ETF that actually invest in those developing countries.
Yeah.
Yep. All right. Let me pick up some questions. Okay, there's some macro questions. Maybe I think your interest is quite there as well. So maybe let me just put some macro questions here. There's one question from Kim Hawk. Do you see globalization giving way to bi-bealization? So something new to me. Two world economies led separately by US and China.
I think it's not US and China, but it's maybe the West and the East. And you could see that the West are trying to decouple from globalization. And but for the East, we wanted friendship, we wanted to connect. We still, especially for Singapore, right? Because we're so small and we cannot survive without partnership with other nations. But of course, the threat is always there. Therefore, you can see that even Singapore is a small country. In the recent development, we want to have our own water, want to have our own egg now. We are making our own chicken meat from a lab. So okay, it's a very big thing. So we want to do our own hydrogen power from water. We can convert to energy. So, but before all this come to fusion, I think we still want trades. I think for US, they try to create their own economy, which I think is a little bit sad to hear that, because I think even as an individual, we always believe partnership, right? So, okay, because that one is a bit political, I don't want to go into that. Your question, I think, is a bit too political. I think it's very difficult for me to answer. But it could be because of that, what I'm seeing across, because the mandate, our mandate is always that whoever want to make friends, build partnership in business, that economy will thrive and grow, right? So you're just going to study into which region are still opening up their economy and want to make friends and partnership and form alliance in business. I think those region will prosper in a very challenging time. I think that's why I've selected Asia. I think that's a question is difficult to answer, but it's also that question that drives me to why I've selected Asia. Yeah.
Right. I think sometimes it's just an opinion. Everybody has an opinion, but at the end of the day, it's knowing the market and knowing what you invest in. I mean, always invest in what you know, and not what you do not know.
Yeah, maybe Nixon is getting late. I'm a bit concerned about. I'm happy to take on more question. Maybe we consider the last question, or we can.
Yeah, I would.
Before we lost our
macro
audience.
team. I'll just pick one last macro team, and then for the rest of the questions, I think we, due to the time limitation, you have Kong Hao's contact, so do feel free to contact him. Either through email or through his social media. His YouTube, I believe, has a lot of insights that you can actually just watch a video, and I think you will find a lot of your answers answered in those videos. Okay, one macro question. Will the current US situation lead to stagflation?
I think there's a possibility. In fact, as the month passed, where the CPI continued to move higher, and there's talk about potential slow growth coming up for next year, 2023. So now they're talking about slow growth ahead in 2023. And at the moment, they still cannot confirm whether recession is going to hit. But most of them predict that recession will hit next year, right? Next year, which is 2023. Where if the CPI continue to move up means inflation pick up, then that became a stagflation. Stagflation means that a high number of people are unemployed and the price continue to move up, which is double whammy, which is bad. So there's a situation of stagflation. So look out for the recession confirmation by this body called NBER. If NBER declare that the recession hit, means that slow growth will come. If CPI continue to keep track of the CPI every month, CPI continue to hit 8, 9, or 10, then stagflation is. You don't have to wait for an official statement, but you will know that recession come plus high CPI number, that's stagflation already. So it's just like, to me, the recession is already here. I don't have to wait for NBER to declare that recession is here, because NBER, they use GDP. But if you're going to use S&P, NASDAQ, or Dow Jones, because their concept is NBER, they use 2 quarters, that means 6 months of down quarters of GDP is down, is recession. But so far from Jan to March, from April to June, has been down 2 quarters, but they have yet declared that is recession for US, right? So, but if you look at the first quarter, second quarter, even the third quarter of S&P, NASDAQ, or Dow Jones is 3 down quarters already. So to me, it's really technically recession. Yeah, it's just that NBER have not declared, but the stock market really tell me that it's already in bear market. Recession, it has already arrived. So that's based on the stock market. So I just want to give you this last strategy instead of waiting for NBER or official statement to make the announcement. So sometimes when we look at a financial market, is the straightforward answer, because when we look at the price, it's really telling you that it's happening. So you don't have to wait. Just look at the numbers, look at the chart, look at the market. It is very, very telling. So, okay, with that, thank you.
Thank you, Kong Hao.
Much, yeah.
With that, allow me to just summarize a bit. So for those who have not done the feedback, do it after the webinar. The link is in the chat, as well as the QR code. And also, just to share with you, Kong Hao will be coming back to share with us one final time for the year on 15th of December 2022. So we have yet to identify a topic, but do give us your feedback in the feedback form, because that also allows us to pick a topic of your interest, and we will get Kong Hao to share with us again his view in December. And it'll be interesting, Kong Hao, it'll be 2 months from now. A lot of things could happen, and we will definitely love to wrap up the year with Kong Hao to look at what happened this year, and more importantly, how we can look forward to next year. So let me also just share that link with all of you. Okay, you can scan the QR code, or you can use the link that I'm going to share in the chat box here. Okay, so do pre-register for the event so that you are logged in, so that we can then hear from Kong Hao again. So with that, and of course, don't forget your feedback form. So with that, really thank you to Kong Hao for your, again, very insightful sharing, and also answering some of the wonderful questions from the audience. Thank you for your participation. And all the people who are attending tonight. I hope that we have answered most of the questions. We do apologize that we can't go through each and every one, but we try as our best as we can to answer all the questions. But if you do still have burning questions, do feel free to contact Kong Hao by his email and social media platform. And so with that, I'd like to end the session. Thank you, everyone. Once again, have a good evening and a good week ahead.
Thank you, Nixon. Thank you all. Thank you.
Bye-bye.
Bye.